And if you don't understand what that message means, the next move in silver could catch you completely off guard in either direction. Welcome back, I'm James. Today is February 16th, 2026. This is your macro and structure breakdown on silver. Not predictions, not hype. Structure, mechanics, the forces underneath the price that determine where it goes next. If you're watching this channel for the first time, this is where we do things differently. We don't scream about price targets. We explain how markets actually work. The plumbing, the positioning, the cross-asset relationships that 90% of market commentary ignores entirely. If you're watching this channel for the first time, this is where we do things differently. We don't scream about price targets. We explain how markets actually work. The plumbing, the positioning, the cross-asset relationships that 90% of market commentary ignores entirely. If that resonates with you, subscribe. It helps the channel more than you think. Drop a comment telling me where you're watching from today, and answer me this honestly. Do you think silver breaks above $80 on this run, or does it get rejected? Just type breakout or rejection. I want to see where this community stands before I walk you through what the data is actually showing. Because right now, the data is telling a more complicated story than most people realize. Let's set the stage. Silver futures, specifically the March 2026 contract SIH26, are trading in the 76.40 to 76.90 range. That's up roughly 1 to 2% on the session. That's elevated. That's near multi-year highs. And importantly, that's within striking distance of the psychological $80 level that every single trader, analyst, and commentator is watching. $80. It's a number that carries weight, not because of any technical formation or Fibonacci level, because it's round, because it's memorable, because human beings anchor to round numbers. And in markets, when enough participants anchor to the same level, that level becomes real. It becomes a magnet, it attracts orders, it attracts attention, and ultimately it attracts a decision. Does price push through, or does it fail? Right now, silver is consolidating below that level. The structure is elevated but stretched. Momentum is intact but mature. And into that setup, the CME has just raised margin requirements on COMEX silver futures. That margin hike is the variable that changes the calculus of this entire setup. And I want to spend serious time today explaining why. Because margin is the plumbing. Margin is the infrastructure. And most traders treat it like a footnote when it's actually the foundation. Let me start with the macro environment because it frames everything. The dollar index, the DXY, is holding steady near 96.9 to 97.0. That's firm, not surging higher, not breaking down. Firm, stable, persistent. And for silver, a firm dollar is a headwind, not a hurricane. A headwind. It makes silver more expensive for international buyers. It signals that U.S. financial conditions aren't loosening dramatically. It keeps a lid on the impulse momentum that metals need for aggressive breakouts. Now here's what makes the current situation unusual. Silver is near multi-year highs despite the dollar holding firm. In a typical environment, a DXY at 97 would be suppressive for metals. You'd expect silver to be pulling back or consolidating at lower levels. Instead, silver is pressing higher, challenging $80, with the dollar working against it. That tells you the underlying demand for silver is strong enough to overcome the currency headwind. And that's noteworthy, because when an asset rises against its natural headwinds, it signals genuine structural strength underneath. But structural strength and invulnerability are not the same thing. Silver can be structurally strong and still be tactically fragile, and that's exactly where we are right now. Here's the first cliffhanger. If silver is strong enough to rally against a firm dollar, if the underlying demand is genuine, why would a margin hike matter? Shouldn't real demand overwhelm a technical adjustment by the exchange? Or does the margin hike reveal something about the quality of the rally that price alone can't show you? I'll answer that in detail. But first, let me walk through the positioning data because it tells you who is actually in this trade and how exposed they are. The most recent commitments of traders data shows open interest at approximately 172,415 contracts. That's active. That's engaged. Not the most extreme level we've ever seen, but meaningfully elevated. It tells us there is significant capital committed to silver futures positions right now. Let's break down who holds what. Non-commercial traders, your hedge funds, your commodity trading advisors, your speculative capital hold 67,041 long contracts versus 23,860 short contracts. That's a net long position of roughly 43,181 contracts. That's a strong bullish bias from the speculative community. These are the momentum traders, the trend followers, the participants who entered because silver was going up and they expect it to keep going up. On the other side, commercial traders, your miners, refiners, Industrial consumers and forward hedgers hold 46,432 long contracts versus 111,087 short contracts. That's a net short position of approximately 64 by 655 contracts. That's substantial hedge pressure. The producers are selling into this strength. They're locking in prices. They're protecting revenue. Now here's the framework I want you to hold in your mind. When non-commercial longs are elevated and commercial shorts are elevated, it means the speculative community is betting on continuation while the producers are betting on protection. Those two groups are on opposite sides of the trade. And historically, when the gap between them widens to this degree, the market is entering a zone of heightened directional risk, not because either side is wrong, but because one side will eventually be proven right and the other side will need to adjust, and that adjustment creates the volatility. Now here's where the margin hike enters the equation, and this is the core of today's analysis. Let me explain margin mechanics from the ground up, because even experienced traders sometimes have an incomplete understanding of how this works and why it matters so much at moments like this. When you trade silver futures on COMEX, you enter a contract that represents 5,000 troy ounces of silver. At $76 per ounce, one contract controls approximately $380,000 of notional value. But you don't post $380,000. You post margin, a fraction of the total value. That margin serves as your performance bond. It's the exchange's guarantee that you can absorb adverse moves in your position. There are two margin levels that matter. Initial margin, which is the amount you need to post to open a new position, and maintenance margin, which is the minimum amount that must remain in your account to keep the position open. If your account balance falls below maintenance margin because the trade moved against you, your broker issues a margin call. You either deposit additional funds immediately or your position gets liquidated, automatically, at market price. No negotiation. Now here's what happens when the CME raises margin requirements. Every existing position holder suddenly needs more capital in their account. Not because they lost money, not because price moved against them, simply because the exchange changed the rules. The performance bond got bigger. The collateral requirement increased. For well-capitalized traders and institutions, this is manageable. They post the additional margin and continue holding. The hike is an inconvenience, not a crisis. But for leveraged traders, traders who entered near their capital limits, who used most of their available funds to establish positions during the rally, this margin hike is a direct threat. They were already close to their maintenance threshold, and now that threshold just moved higher. Their buffer just got thinner. These traders are now in a precarious position. If silver stays flat, they might survive. But if silver dips even modestly, even 1 or 2%, the combination of the price decline plus the higher margin requirement could push them below maintenance. Margin call. Forced liquidation. And here's the mechanical danger that most people miss. When the CME raises margins, they don't do it because the market is calm. They do it because they see elevated volatility, elevated participation, an elevated risk of clearing member defaults. The exchange is a risk manager. And when the risk manager tightens collateral requirements, they're telling you something. They're telling you that the current level of leverage in the market is making them uncomfortable. Think about that. The institution that runs the marketplace, that sees every position, that knows the aggregate exposure across all participants, looked at silver and said there's too much risk here. We need more collateral. That's not a bullish signal. That's not a bearish signal. It's a fragility signal. It tells you that the market's internal risk level has crossed a threshold that the exchange deems concerning. And this margin hike hits at the worst possible time for bulls, not because the trend is broken. The trend is intact, but because the hike arrives precisely when price is approaching the most watched level on the board, $80, the level where every trader has orders placed, where every analyst has drawn a line, where the maximum amount of attention and positioning is concentrated. Margin hikes near major psychological levels create a toxic combination. Let me explain why. As silver approaches 80, buyers get excited. Momentum traders add, breakout traders position for the push-through. Open interest rises as new participants enter. Leverage in the system increases. Simultaneously, the CME raises margins, which increases the cost of that leverage. Every new position requires more capital. Every existing position needs additional collateral. So you have maximum participation meeting maximum capital requirements at maximum psychological anticipation. That's a pressure cooker. If silver breaks above 80 cleanly, the longs are vindicated, and the shorts cover, which could accelerate the move higher. That's the breakout scenario. But if silver stalls at 80, if it touches and fails, the dynamics reverse instantly. Disappointed longs begin exiting. The margin hike amplifies the pressure because their buffers are already thin. Stop losses trigger below 80. Selling creates more selling. And the same leverage that powered the rally becomes the fuel for the decline. That's the bull trap scenario, and the margin hike makes it more dangerous than it would otherwise be. Here's the second cliffhanger. There's one piece of data that I haven't discussed yet that might tell us which scenario is more likely. It's not the COT. It's not the DXY. It's not the yield. It's the PSLV discount. And what it reveals about real physical demand versus future speculation might change how you think about this entire setup. Let me get there now. PSLV, the Sprott Physical Silver Trust, is one of the most important data points in the silver market that most futures traders completely ignore. PSLV holds real physical silver in vaults, not derivatives, not paper contracts, actual metal, and its pricing relative to its net asset value tells you something that no futures chart can. As of February 11, 2026, PSLV's net asset value stood at approximately $28.84 per share. The market price of PSLV shares was approximately $27.0. That's a discount of roughly 6.4%. Let me explain what that means. When PSLV trades at a discount to its NAV, it means the market is valuing the shares at less than the value of the silver they represent. You're effectively buying silver at below its spot price through the trust. Now, in a market where physical demand is euphoric, where buyers are scrambling for metal, PSLV typically trades at a premium. Buyers are willing to pay more than NAV because they want the exposure and they want it now. Premiums signal urgency. Premiums signal conviction. Premiums signal that physical demand is running ahead of supply. A discount tells you the opposite. It tells you that physical demand is present but not frantic. It tells you that buyers are interested but not desperate. It tells you that the silver market at the physical level is functioning normally. There's no panic, no squeeze, no acute shortage driving premiums higher. And this is a critical piece of context for the $80 trade. Because if silver were approaching $80 on the back of screaming physical demand, if buyers were paying premiums for PSLV, if the physical market were in crisis, the breakout case would be much stronger. The real-world demand would validate the futures move. The paper and physical markets would be aligned. Instead, what we see is a futures market pressing toward 80 with strong speculative momentum, while the physical market is orderly, calm, and actually offering a discount. That's a divergence. Not a dramatic one, not a dangerous one, but a divergence. It suggests that the push toward 80 is being driven more by futures positioning and speculative momentum than by a surge in real physical demand. And momentum-driven moves are inherently more vulnerable to reversal than demand-driven moves. This doesn't mean the move is fake. Momentum is a real force. Speculative capital is real capital. But it does mean that if the momentum stalls, if the speculative bid pauses, there may not be enough physical demand underneath to prevent a pullback. And that's why the margin hike matters so much right now. Because the margin hike specifically targets the speculative, leveraged capital that's driving the move. It doesn't affect physical buyers. It doesn't change anything for someone accumulating coins or bars. It only impacts futures traders using leverage. And those are the traders most responsible for the current push toward 80. Tightening the leverage on the exact participants driving the rally while the physical market remains calm is like pulling the rug out from under a dancer mid-step. They might land on their feet, or they might fall. Now let me bring in the cross-asset context to complete the picture. The dollar at 96.9 to 97.0 is firm. I've already discussed this. What I want to add is the implication of dollar stability specifically at this moment. A stable dollar means the metal's tailwind from currency weakness is not present. Silver is doing this on its own, on momentum, on positioning, on speculative conviction. That's impressive. But it also means there's no macro cavalry coming to help if the rally stalls. If silver needs the dollar to weaken to push through 80, and the dollar doesn't cooperate, the rally has to find fuel from somewhere else. And right now, the only other fuel source is more leverage, more speculative longs, more futures buying. But the CME just made that more expensive. See how these forces interact? The dollar isn't helping. The margin hike is restricting leverage. The physical market is orderly but not urgent. And the speculative community is already net long 43,000 contracts. The upside fuel is getting constrained at exactly the moment when the market needs the most fuel to break through the biggest resistance level on the chart. That doesn't mean it can't happen. Markets do surprising things. A breakout above 80 is absolutely possible. But the structural setup suggests that if it happens, it needs a new catalyst. Something that changes the macro equation, a dollar breakdown, a yield collapse, a geopolitical shock, a physical demand surge. Without a new catalyst, the approach to 80 is a momentum move that's running into increasing structural resistance. Margin resistance, dollar resistance, and the natural resistance of a round number that every participant is watching. Now let me map this into two clear scenarios. Scenario A is the genuine breakout. Silver pushes through $80 and holds. This scenario becomes credible under the following conditions. First, silver breaks above 80 on strong volume and the daily close holds above that level. Not a wick above 80, not an intraday touch. A decisive close above 80 that tells the market the level has been claimed. The close matters more than the intraday spike because it represents the final consensus of all participants after a full session of trading. Second, open interest rises alongside the breakout. If new contracts are being created as price pushes above 80, it means new capital is entering. New longs are committing at higher prices with full awareness of the elevated margin requirements. That's conviction. That's fresh fuel. That's the kind of participation that sustains a move. Third, the dollar weakens below 96. A DXY break below 96 would remove the currency headwind and add a genuine macro tailwind. It would make silver cheaper for international buyers. It would signal loosening financial conditions. And it would provide the fundamental justification for higher prices that pure momentum alone can't sustain. Fourth, PSLV's discount narrows or flips to a premium. If the physical market starts confirming the futures move, if PSLV buyers start paying above NAV, it means real demand is catching up to speculative demand. Paper and physical alignment is the strongest possible foundation for a sustained breakout. Fifth, yields soften. If the 10-year drifts below 4.10%, the opportunity cost of holding silver decreases. Capital that was parked in treasuries becomes more willing to explore alternatives. The macro headwind becomes a tailwind. If all five of these conditions converge, the breakout is real. $80 becomes a floor, not a ceiling. And silver targets the next psychological zone at 85 and eventually the historic round number at 100 that the market has waited decades to revisit. Scenario B is the bull trap. Silver touches or approaches 80, fails, and reverses sharply. This scenario becomes credible under the following conditions. First, silver touches or wicks above 80 but fails to close above it. The daily close falls back below 80. This would signal that the selling pressure at that level overwhelmed the buying pressure, that every trader who had sell orders at 80, every producer who hedged at 80, every commercial who shorted at 80 won the day, and the longs who chased the breakout are now trapped above a level that's been rejected. Second, open interest declines. If open interest drops as price falls away from 80, it's the definitive signature of long liquidation. Traders are closing positions, not adding shorts. Exiting, being forced out, and each exit pushes price lower, which forces more exits. Third, the margin hike triggers cascading margin calls. Traders who entered near the highs with thin capital buffers are the first to go. Their forced selling creates a downdraft that triggers stops on other traders. The margin hike amplifies this because the threshold for margin calls is now higher. Less room for error. More traders in the danger zone. Fourth, the dollar strengthens above 97.5 or toward 98. A stronger dollar would add macro pressure on top of the positioning pressure. Silver would face selling from multiple directions simultaneously. Leveraged longs exiting. Dollar strength compressing. Momentum reversals triggering technical selling. Fifth, PSLV's discount widens further. If the physical market becomes even less urgent as futures fall, it confirms that there's no physical floor underneath the speculative move. The paper market overshot, and the physical market isn't willing to catch it. In this scenario, silver doesn't just pull back, it flushes. The concentration of positioning at 80, combined with the elevated margin requirements, creates the conditions for a fast, sharp decline. Air pockets, gaps, the kind of move where traders say it happened so fast I couldn't react. And I want to be very clear. A bull trap and flush at 80 would not invalidate the longer-term case for silver. The supply deficit is real. Industrial demand is growing. Mine supply is constrained. The secular story remains intact. But secular stories don't protect leveraged traders from tactical destruction. The long-term trend can be up while the short-term move takes your account. That's the nature of leveraged markets. And that's why understanding the margin dynamics, the positioning, and the physical versus paper divergence matters so much right now. Here's the third cliffhanger. If the margin hike targets leveraged longs and the physical market is calm, who exactly is on the other side of this trade at $80? Who is selling into the rally? Who benefits from the margin pressure? And what does the commercial positioning, net short over 64,000 contracts, tell us about who is positioned to profit from a failure at 80. The commercials, the producers, the miners, the refiners, the people who actually produce the metal that the speculators are trading on paper. They've been selling forward into this rally. They've been hedging at higher and higher prices, and they've been building short positions that profit if price reverses. That doesn't make them villains. They're running businesses. They're protecting revenue. They're doing exactly what rational producers should do when prices are elevated. But their positioning tells you something important. The people with the most intimate knowledge of the physical silver market, the people who know exactly how much metal is in the ground, how much it costs to extract, and how much demand they're seeing from their actual customers, those people are selling aggressively. The speculators are buying, the producers are selling, the exchange is raising the cost of leverage, and the physical market is offering a discount. Read that paragraph again, then ask yourself which side of this trade has more information. I'm not saying the speculators are wrong. They could be absolutely right. Silver could break 80 and never look back. But the weight of evidence right now suggests caution, not bearishness, not panic. Caution, and that's my stance. Cautiously bullish. The trend is up, the secular case is strong, but the tactical environment at $80 with elevated margins, heavy commercial hedging, a firm dollar, and a calm physical market, that environment demands respect. It demands risk management. It demands awareness. Now let me give you the watch list, 5 things I'm tracking every day, starting now. Number 1, the daily close relative to $80. Not the intraday high, not the wick, the close. A daily close above 80 that holds the following day is the single most bullish signal possible for silver right now. A rejection at 80, a wick above followed by a close below, is the single most dangerous signal for leveraged longs. The close is the truth. Everything else is noise. Number 2, open interest trajectory. Watch the weekly changes. If open interest is rising with price, the market is expanding. New money is entering. The move has fuel. If open interest is declining, especially while price is falling, liquidation is underway. The move is losing participants, not gaining them. Under the new elevated margin regime, open interest changes are even more significant because they tell you whether traders can afford to stay in the market. Number 3, PSLV discount or premium. This is the physical demand barometer. A narrowing discount or a flip to premium means physical buyers are stepping up. It validates the futures move. A widening discount means physical demand is not confirming the paper rally. Check this daily. It takes 30 seconds and it gives you information that 99% of silver traders don't look at. Number 4, DXY behavior around the 97 level. A clean break below 96.5 would add a tailwind to silver and increase the probability of a genuine breakout. A push above 97.5 or 98 would intensify the headwind and increase the probability of a reversal. The dollar is the macro swing variable. It's the one input that can change the entire equation overnight based on a single Fed comment or economic data release. Number 5, commercial positioning changes in the next cut report. If commercials reduce their net short exposure, meaning they cover shorts or add longs, it signals that the smart money is becoming less defensive. That would be constructive. If commercials increase their net short exposure further, it means they're doubling down on protection at these levels. That's a warning that the people closest to the physical market see risk here. That's the checklist. 5 signals. Objective, measurable, no opinions, just data. Let me close this out. Silver is in a fascinating position right now. It's rallied through headwinds. It's pressing toward the most significant round number in modern silver history. And it's doing so with enough structural support to make the move legitimate, but enough tactical fragility to make it dangerous. The margin hike is the X factor. It changes the behavioral incentives for every leveraged participant. It increases the cost of being wrong. It reduces the buffer for holding through volatility. And it arrives at the moment of maximum anticipation as price approaches 80. The physical market through PSLV is telling us that real demand is steady but not euphoric. The positioning data is telling us that speculators are leaning long and producers are leaning short. The dollar is telling us that macro conditions are not actively helping metals right now, and the exchange itself is telling us that risk levels warrant higher collateral. None of these signals individually are definitive, but together they paint a picture of a market that is trending higher, but doing so on a foundation that is less stable than the price chart alone would suggest. And that's why my stance is cautiously bullish. I respect the trend. I respect the structural case. But I also respect the margin dynamics, the positioning concentrations, and the physical paper divergence at this level. This is the time for awareness, not recklessness. Know where your exposure is. Know what your margin requirements are. Know what happens to your position if silver moves $5 against you. And know what happens if it moves $5 in your favor, because under the new margin environment, even winning trades can generate unexpected margin demands. This is education only, not financial advice, not a recommendation to buy, sell, or hold any asset. I'm showing you the mechanics so you can make your own informed decisions. Always manage your own risk. Now I want to hear from you. 2 questions. Question 1. Binary choice. Will silver close above $80 within the next 30 days? Yes or no? Just one word. Question 2. Pick one of 3. Which data point are you watching most closely right now? A. The daily close relative to $80. B. PSLV premium or discount. C. Commercial positioning in the QOT report. Pick one and tell me why in the comments. I read every comment. Your responses directly shape what I cover next. And on a setup like this, where the market is genuinely at a decision point, your collective perspective adds real value to the analysis. I'm James. Today is February 16th, 2026. Silver is pressing toward 80. The exchange just raised the stakes. The producers are hedging. The physical market is calm. And the next few sessions could define the trajectory for weeks. Stay sharp, stay disciplined, understand the plumbing, and manage your risk. I'll see you in the next one.